Financial management is something many people find complicated and hard to understand, with all the jargon and complex formulas. In fact, financial management is not mysterious. Today, I'll introduce a simple and practical method, the 50/30/20 rule. Even if you're new to finance, you can easily get started and begin your journey toward wealth growth. Let's first talk about what the 50/30/20 rule actually is. The 50/30/20 rule was proposed by American celebrity Elizabeth Warren. After decades of research, she found that most people should divide their money into 50%, 30%, and 20%. It's an incredibly simple money allocation formula. Take your monthly income, whether it's your salary, bonuses, or money earned from a side job, and divide it into three categories. 50% needs, rent, utilities, food, transportation, etc. 30% wants, entertainment, shopping, travel. 20% savings and investments, saving money, investing, paying off debt. Simply put, 50% is for survival, 30% is for enjoyment, and 20% is for building wealth. If your necessary expenses exceed 50%, what should you do? Cut costs. Here's one way to do it. Move to a cheaper place. In the U.S., rent and property prices can vary greatly between cities. In big cities like New York and Los Angeles, rent could take up 30% or even more of your income, while in smaller cities, it might only be around 20%. So if you're feeling the pressure of high rent, consider moving to a place further from the city center or find some reliable friends to share a rental. This can help you save a lot of money. Cut down on takeout, cook your own meals. Eating is a daily necessity, but cooking at home is definitely cheaper than dining out. Take some time on weekends to shop for groceries and prepare a few hearty meals at home. Not only will you eat healthier, but you'll also save a significant amount of money. Plus, many supermarkets have sales and discounts. Keep an eye out, and you'll be able to grab high-quality ingredients at a great price. Use public transportation instead of driving. If you live in an area with good public transportation, try taking the bus or subway as much as possible. Over the course of the year, you'll save a lot on gas and parking fees. If driving is unavoidable, consider carpooling with coworkers or neighbors. It's not only eco-friendly, but it also helps you share the cost of fuel. First, ensure your basic living expenses, then consider other spending. 30% for enjoying life includes Starbucks, traveling, online shopping, movies, music, and streaming subscriptions. For example, you could allocate 30% of your income as entertainment funds each month to spend on things like movies, dining out, or buying games. Once the money is used up, you'll have to stay at home and enjoy free activities like watching TV shows or reading books. This way, you can still enjoy life while controlling your spending and avoiding overspending. The 30% budget is for enjoyment but won't leave you broke. Finally, 20% is for getting rich, and it's the most important part. You should allocate 20% of your income to building an emergency fund, at least 3 to 6 months worth of living expenses, savings and investments, paying off debt. Even if you save just a few $100s a month over time, it will accumulate into significant wealth. There are various investment options such as stocks, mutual funds, and bonds. For financial beginners, stocks can be risky, so it's not advisable to invest too much at the start. Mutual funds are more suitable for beginners because they are managed by professional fund managers, and the investments are diversified across multiple stocks or bonds, reducing risk. You can allocate a portion of your monthly income to regular mutual fund investments. Bonds are also a more stable investment option, offering relatively fixed returns and lower risk. Although investing carries risks, with proper planning, it is still possible to achieve good returns. Considering that everyone's family situation is different, you can adjust the 50/30/20 rule according to your own circumstances. If you're a renter and your rent expenses are relatively low, you can increase the percentage allocated to discretionary spending and savings/investment. If you're paying off a mortgage and a mortgage payment is a heavy burden, you might need to lower the discretionary spending percentage to ensure that you can cover essential expenses and still contribute to savings/investments. The key is to find a balance that works for you and allows you to maintain financial stability while still making progress toward your financial goals. The 50/30/20 rule is like a magic key that can unlock the door to wealth management. Starting from today, grab a pen and paper and figure out how to allocate your income. Who knows? In the near future, you might achieve your financial goals and live the life you've always dreamed of. Just thinking about it is exciting. If you found this helpful, don't forget to like and subscribe, and let's become financial experts together.